Okay, folks, good evening. Welcome back. So we're taking a look at, or another look at, if you will, of model number 5. And it's a day trading model. And I'll kind of want to briefly go through, kind of give you like a preview of what we'll be doing, but not as detailed, obviously, in 2020 when we go through the models again. So the initial lesson, then we go back in again, do another amplified perspective, and I use examples. And then in 2020, starting in January, we'll do Model 1 and a detailed trading plan. So how you actually go through the process. Okay, so I kind of want to go through some bullet point perspectives on how you can kind of do it now with what you have, and every model that's going forward, for the new members. Obviously, the 2016, 2017 group, they have already received all 12 models. But we looked for the inception of a move, okay? And we want to know where it's going. Some of the questions that you probably have in your mind right now, you've learned a great deal with me through the mentorship. But everything feels disjointed. You can see things when I show you the examples, or you see things, fragmentally on your own, in your own study. But you just don't know where to place those pieces together. And I kind of want to give you a real simple little recipe, okay? And without all the details, you can do all the work yourself and flesh out each individual thing because of the content that was taught to you in the core mentorship material. So when we look at the pairs that we're considering trading, I'm using this pair here because it just so happens to be the only pair we were really focusing on for this particular week, week ending June 28th, 2019. So we felt, or at least through my analysis and my commentary, that we felt the dollar CAD was going to go lower. Now, it's not enough to know or believe that the market's going to go lower. We have to have some supporting evidence to support the idea, or the premise, if you will, that the market will, one, move in your direction, but specifically to what level. What is it going for? What's the draw on liquidity? So we have to have, number one, a point of origin. Okay, so what are we going to be using for our criteria? We've been spending a great deal of time in recent weeks and last couple months with fair value gaps, because much like order blocks, once you understand some central tenets about the fair value gap, they're fairly easy, and they're easy to spot and price. So, and they're not really ambiguous. They're very clear. They're not something that you have to look at and try to decipher, is this a fair value gap or is this not a fair value gap? It's simply a fair value gap. Okay, so our point of origin, okay, or the premise of the setups are going to be fair value gaps. And we're going to incorporate that again with model number 5. And we have to go into the market and determine our bias. Now, how do we do that? We have to consult the higher time frame charts. And we are here on the weekly chart. And we're anticipating a weekly range expansion. This is what makes our high probability setups high probability. So this is the daily range that we just created this week. So today, when we had the market close, we closed here, but the weekly range was down. So my forte as a trader, that makes me ICT, is that I work within this framework every single week. This single candle is the only thing that I'm honestly trying to forecast in my own analysis with the highest degree of probability and accuracy. Obviously, you've heard me talk in instances where I felt that the market can move longer term one way or the other, but I don't trade that way. So my forte, my expertise, if you will, is day trading and very short-term trading, the weekly range. I believe that it suits me best, but it's not to say that it's the best for you. That's the reason why I taught you all of the components of price action trading, so that way you could be a position trader all the way down to a scalper if you wanted to be. Obviously, the highest order of student would be to be able to use all of those things whenever it's valid to do so. And none of you are close to doing that. Okay, just letting you know that if you don't feel that you're up to snuff, if you will, or up to par to do something like that, it's realistic thinking, because you shouldn't be expected to do that. It takes decades to do that. Okay, so, and you may never even reach it. It's not required, it's not needed to be profitable. So, we determine our bias is bearish. Now, how did I come up with the bias for dollar CAD? Why did I focus on dollar CAD this past week over euro and cable? Well, the higher time frame weekly chart, the down close candle, or the expansion on the downside, we're not trying to predict the close. We're just looking for an expansion in one direction over another. So we're incorporating power 3 on the weekly chart. So we're simply looking for an open, very modest upside, if at all, and majority of the range on the downside. So our power 3 is bearish for the weekly range. So we want to be shorting. Okay, that's what we're looking for. Why are we expecting the price of dollar CAD to go lower? Well, we're looking for the draw on liquidity at this old low. The market's been heavy. We filled in a fair value gap back here. This SIBI, sell-side imbalance, buy-side inefficiency, was filled in. And we had recently entered a bearish stance for the near term for dollar. Gold prices, I didn't mention it the last couple times we had our sessions, but I mentioned that we need to be watching the gold market, because if it was to go higher, that would make it easy for the dollar to go lower and foreign currencies to have a higher probability to rally going higher. Well, this pair here begins with the dollar. So dollar CAD, when this is dropping, it's basically saying that the dollar is falling weaker to the Canadian dollar. Okay, or Canadian dollar is stronger relatively speaking in terms of the dollar. So if we're bearish on dollar, this pair also should have very little opposition or resistance, if you will, in terms of momentum, reaching for downside objectives. So when we use our PD array matrix, we're looking for discount arrays that the market would reach for. Logically, there's nothing really in here to frame. There's this down close candle here. We can't really use that as a bearish down close representing a bullish order block, because we've already consumed all that here. So we can consider, obviously, the lowest down close, which would be the rejection block, which it handsomely traded to. Or we can use the old low and then the sell side liquidity resting below that, which is exactly what I told you during the commentary the last two times we were talking about dollar CAD. So we have our draw on liquidity. We have the weekly range expansion. We think that the market's going to go lower based on the things I just mentioned here. So we can drop into a daily chart and anticipate each daily range to expand downward, reaching into that old daily low, 130.68. It was actually 130.67.7, I believe. Let's go back here and see what it is. Yeah, 130.67 and 7 pipettes. So essentially, that would be 130.68 on any broker that doesn't do pipettes, which is why I've rounded it to 130.68. Okay, so the next procedure that you would utilize is that you would be stalking every day a fair value gap using the previous day's range. And I taught recently that the high probability fair value gaps are going to be in the lower 50% of the previous daily range when the market's bearish. So fair value gaps that you would look to sell into, go short, they would form generally in the lower half of the previous day's range. Now, if we were looking at a market that was bullish, obviously the opposite would be said. The high probability fair value gaps, and when it's bullish, would appear or form. The gap would exist, if you will, in the previous day's range, upper 50% of the previous day's range. Okay, so that would make it a high probability fair value gap to go long in, when all of the other factors, as we mentioned here for higher time frame, would indicate higher prices. But as it were, we were talking about the dollar CAD being bearish, and we were looking for this old low to be attacked. So and the liquidity resting below that. So sell side liquidity was our objective, okay, or the terminus. So our analysis led to a directional bias. It led to a target at which we would anticipate price reaching to. And every individual day, we would stalk fair value gaps to go short in. But they have to form during a kill zone. So in other words, the first return back to a fair value gap during a kill zone, London kill zone or New York kill zone, which is specific for this price action model. Using that, you're not limited to just trading the London and New York. Okay, even though the framework for this model is such, you can obviously trade the London close kill zone, and you can also trade the Asian kill zone. And if you feel inclined, you can trade the New York close kill zone. But generally, New York kill zones, New York close kill zones rather, they're more typically predisposed to go for longer term position entries, like continuations into larger moves, like London close too. So when we have that first return to fair value gaps during a kill zone, what are we using for our entry? Well, I recently taught you the institutional order flow entry drill, where you were practicing and you did 4 weeks of back testing, and then you did 4 weeks forward testing. So you should have all that data now. And all that data collected should have illustrated to you that there is a numerous amount of setups, and there's a plethora of pips available. Well more than you probably thought. So there's not a shortage of setups. There's not a shortage of opportunities either. But you don't need to have every one of those pairs. I gave you a homework assignment doing that back testing to kind of like show you that once you know what you're looking for, you don't have to stick to one pair or two in the beginning. You want to do that when you're learning. But if you want to have a basket approach where you're using a larger number of assets to find and filter setups in, you've been proven by your own homework and your own work doing back testing and forward testing that there is no shortage on setups using the fair value gap and the institutional order flow entry drill technique for entry, which is the low end entry. You're not looking for the entire gap to fill. You're not looking for consequent encroachment either. You're using the lowest point of entry for selling short in a bearish fair value gap, or buying the highest point of the gap when it's a bullish fair value gap. Once we have the setup in mind and we see it in the chart, we know where the price is most likely to expand on the daily and on the weekly. Using Model 5, we can see that confluence of intraday standard deviations on flout, on central bank dealers range, and on the Asian range. So it gives us targets, if you will, every single day, but this model specifically aims for 40 to 50 pips per setup. So that's the premise, or the focus, if you will, of this particular model. You can graduate into larger one-shot, one-kill scenarios by leaving a portion of the trade on. Now, right away, quickly, some would say, well, if you're taking a large portion of the trade off, and you believe that it's going to go with a one-shot, one-kill, why not just let it go and don't take profits at 40 and 50 pips? And you can do that. This could be the stepping stone to you getting to or arriving at these larger weekly range expansions that go beyond 50 pips. Okay, so, or it can be just utilized as the modular approach to getting your 50 to 75 pips like I do a week, I don't always get the 75 pip high end in one setup. Sometimes I have to do it in 2 trades, or I may require 4. Maybe I've taken a loss or I missed a move and exited the position before it really was a loss or a gain. It was a scratch. I have to go back in and do another transaction to get my goal for the week. So don't think that you have to do the model as it is here and it's limited to that. The approach to me setting down with these specific 12 models was to lay the foundations that when you understand them all and incorporate them together, you will have a complete understanding of price action, and you can work within any model and overlap with them. Okay, and it gives you a depth of understanding that is unsurpassed in the trading community. So let's go over to a 15-minute time frame. In this shaded area here, this is just representing simply a 40 pips. This is our low end objective for this model, and there's nothing more to it than that. I'm just going to show you the day dividers here. Again, this is Friday's trading, Thursday, Wednesday, Tuesday, and Monday. If you were to take this range and just place it over significant highs, you can see that there was simply no real resistance to seeing price get to a 40 pip run on Thursday. Whether you use that high or this high, it simply gave you obviously an easy 40 pips. Now I'll go into the details in a moment because some of you are like, well, you know, it's just completely all hindsight. We have a 40 pip run here from this high, and it went a little bit further than that. Certainly 50 pips was offered on that day. And in here, you can see 40 pips was a no-brainer there as well. And then we have a late day New York setup where it offered, again, another 40 pips. So Thursday, Wednesday, and Tuesday, high probability days, really nice, even though this model is not limited to Tuesday, Wednesday, Thursday trading. It's any day trading. You can filter it by limiting it to the Tuesday, Wednesday, Thursday days. Okay, so highest probability, in my opinion, are Tuesday and Wednesday. So I like to use those days to do most of my hunting. Doesn't mean I'm going to get it. Doesn't mean I'm going to capture it. Doesn't mean it's going to set up. It may require me going into Thursday to get my haul for the week. But looking at price action like this, even though we have a 40 pip range low end objective for this model, looking at the daily dividers like this, right away you know enough. Your eyes are seeing power 3. You're probably seeing the fair value gaps, which we're going to highlight. You're probably seeing the order blocks. You're probably seeing the breakers. That's all part or testimony to your understanding and your learning. What I want you to focus on in this teaching here is not only is it a review with greater detail than we show in the weekly reviews that will be shown tomorrow at 4 p.m. on the forum, it's also to show you the level of precision of what you were introduced to with using model number 5. Okay, so I'm going to take this, remove the daily dividers off, and put some lipstick on this chart a little bit, and we're only going to focus on flout. Okay, I'm going to plot the flout only each day, and we're going to look at what we arrive at using the criteria I just outlined for this model and this particular teaching. Okay, so everything has been added. Now, right away, you're going to be confused. You're going to have doubts and concerns about what these lines are here. The only thing I've done is removed the labels. Okay, I don't want you focusing on the labels because it's caused a great deal of confusion for folks, and I'm answering a lot of emails that can be just simply avoided by talking in this lesson here. It's not imperative that you have a label, because I don't really particularly have labels when I look at my charts. I just look for the confluence of the intraday standard deviations. When they line up, and I'll outline a few here, you probably already see them at the bottom of the chart here. That's all I'm looking for. There's no real science to, like, a standard deviation 2 has to match up with a standard deviation 4. None of that's required. I get a lot of questions that are like that. Is there something that one standard deviation has to match up with another day's standard deviation by a specific range or expansion? No, it doesn't need to work like that. You're really complicating it. Overcomplication if you start doing things like that. So to avoid the confusion, the only thing I've done was removed the labels on the lines here. Otherwise, they would show, you know, the standard deviation 1, standard deviation 2, and so on. That was taught to you in the initial lesson of Model 5. So Friday's trading here, you can clearly see we traded down below that 130.70 level, which has now been calibrated to the nearest 10 level. Remember, the daily low that we were referring to over here on February 1st, 2019, that low is 130.67 and 7 pipettes. We're coming down to that level. So the low-hanging fruit application of targeting and calibrating your levels is what institutional level and what 0 level or what 5 level is the closest to that 167.7 pipettes. 168 is the even round number, but not in the sense that it's a 0 level. It's rounded to the nearest full pip. The nearest 10 level coming down. Remember, this week's range expansion was down. So we started on Monday. The level would be calibrated to 130.70 because 70 is the nearest full 10 level before you get to 68 or 67 and 7 pipettes. Okay, if you didn't catch what I just said, rewind the video and listen to it again. It's very simple. You could use 130.80 as your next institutional level on the downside, and that's fine as well. There's nothing wrong with that. But we were targeting the liquidity below that low, which is important to note because this 10 pip run below 130.70, the low on this particular day here on Friday, came in at 130.59 even. So it's 11 pips run below 130.70. So you can see how calibrating our levels using the low-hanging fruit rounding of our levels. In other words, we're not working with zones. Okay, we're working with specific price levels because if we don't have those specific price levels in mind, we can't do standard deviations and overlays, and you can't do projections with any measure of continuity. If we're going to talk about supply and demand zones, like those individuals that trade like that, they're really guessing as to what they're doing, and that's why they lack consistency. Even though the best quote-unquote supply and demand traders out there, they're not going to show the level of consistency that I'm able to show because of the calibration techniques that I've taught you. So again, if we have an objective, which is an old low here in this example, on that February low, if its daily low figure is 130.67 and 7 pipettes, on another broker that doesn't use pipettes, it would be 130.68. So the nearest 10 level or 5 level, without rounding lower than the actual low, because remember, we're expanding down to it, we want to get to a price level that is high probability of reaching. I don't care, and I don't want to try to sell the idea that I'm projecting the 130.59 level 0 pipettes. That's not necessary. Okay, we're trying to get as close as we can and also allow for the spread to still give us the ability to get out of the trades. So, several factors I want you to take a look at in here. We had the 131 big figure ahead of reaching that 130.70 level, which is calibrated 2 pips above, which would otherwise be seen in other brokerage demo accounts or live account feeds at 130.68. So the protocol is, if we trade through a big figure, it's not just a simple 10, 20, 30. It could expand 40 pips down. Well, 130.59 is essentially what round number? 130.60, right? So we had a sweep of liquidity, 41 pips. You see that? It reached below, but more specifically and precisely, it reached for that February low that we identified the last few times we talked in weekly commentary. And that's this sweep here. Now, the range parameter here, all this is flout. Okay, all I'm doing is identifying the range high and the range low using the bodies, not the wicks. Okay, remember Model 5 tells you that you want to do calibration on your standard deviations on both the wicks and the bodies, and you want to look for confluences. So you want to know those levels. Ideally on your charts, you're going to have one chart that has the flout, central bank dealers range, and Asian range plotted on wicks, and then one on the bodies. And this is the part that takes time, and you have to put some thought process into it and think which levels are calibrated so there's a lot of tight confluences. And what do I mean by that? We have 130.65 down here used on, was this Friday, Thursday, Wednesday, Tuesday's trading. So Tuesday's flout measurements and standard deviations. We have a standard deviation here, lines up perfectly with the low. The other standard deviation projections down here, okay, these are standard deviation and then halves, not just full standard deviation. I have the half levels in here, even though they're not labeled. So in other words, it would be like standard deviation 1, then standard deviation 1.5, then standard deviation 2, then standard deviation 2.5, respectively. But again, we don't need the labels. All we're doing is looking for the actual line each day to see if there's any confluences in the next few days or during the week. So we have 130.65 here. Project that out in time. We have a very close within 5 pips. Again, that's the filter. It's going to be within 5 pips. If we get a confluence within 5 pips or even less than that, it's going to be a level of high sensitivity. So we have one here, and we have this level on here that I don't have actually highlighted. So let me do that now. Okay, so we have 130.54 and 6 pipettes, so basically 130.55. Even if you wanted to say it was 130.54, 5 pips above that would still be 130.59. So it's no matter how you slice it, it's 5 pips variance that you are allowed to have. And then we have 130.59 here on this level. And project that out, and then we have this level here on Friday's flout, very close, certainly within 5 pips of deviation. So confluence is very apparent there. And the low on this day is actually 130.59 even. If I can make it pop up here. There you go. So this is actually showing you one pipette that shouldn't be there. So there you go. So you have confluence of Thursday's standard deviations on flout and the daily low and 10 pips below 130.70, which would be basically 130.60. So it went 1 pip more than you would have with all of your projection studies. We're expecting 130.70 to be tagged. 130.67.7 was the old February low on this feed. We calibrate our level to the nearest 10 or 5 level or institutional level. Nonetheless, no matter how you slice it, it's there. If you would have used the 80 level, okay, a 20 pip run below that would take you to 130.60. So it only went 21 points or pips below. It's all there. It's all algorithmically repeating itself. It just depends on what filter you're going to use. Now, obviously, the more filters you have, the more precise you're going to get, because you're going to be able to do standard deviations and swing projections with the stop runs with 10, 20, and 30, unless you entered the big figure and mid figure thresholds. So we have price sweeping below 131. Now we have to add additional 40 pips. Well, that's wonderful, because it also takes us below that 130.70 level, or 130.67.7, handsomely. So it builds a lot of probability, if you will, that the market will probably on Friday reach this objective that old daily low in February that we outlined the last few times in our commentary. So, with that said, okay, you can also see this standard deviation here on Thursday, called the very low of the day, and on Wednesday, only off by one. What is this? The low is, or the line I have here is 131.07, and the low with 1 pip in the low is, it's only one off by one pip. So again, beautiful, 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 beautiful. So let's take a look at the individual days here. On Tuesday, we had equal highs, price running above that late in the day. So on Tuesday's high, after running equal highs, we have price expand on the downside, leaving a fair value gap in here. Price runs up during the Asian session. Again, this is one of those times where you can additionally add Asian session, not just limited to New York and London. And again, you can use London close as well. But here's an Asian session setup. So during the Asian range or Asian session or kill zone, fair value gap to a bearish order block, trades right there. 40 pips offered, absolutely. Where's it going to run for? Previous day's low. There's liquidity resting below that. The low on that day comes in at 31.51.5. $131.41. So 10 pips below the previous day's low. You see how algorithmically the price always moves in a reasonable and expected manner. It's not random. It's not ambiguous. It's running for liquidity, but in a scale that is measurable, it repeats, and it's something that you can anticipate. The market creates a fair value gap in here. There's one also up in here, but it's inside this swing, so it's not likely or needed to get up in there. This is more pronounced, and if you look at the previous day's range right here, if you measure that, let's do that so you can see. Here is the low to high. So here's that 50% level. Anything below that level down, a fair value gap for this day on Wednesday, you can take a trade. So yes, there's a little bit of fair value gap here. There's one in here, yes. But in the lower half, this is existing as well. This is much more imbalanced. Quickly, distribution comes into the marketplace. Price comes back up, fills in the fair value gap. Here's your sell. During the New York Open, so there's your New York setup. Easy 50 pip run. We have a low of 31.41. The low comes in at 31.6. So over 30 pips for this run here. I'm sorry, from the low down. So we have 30 pip run on liquidity below the low formed in the London Open, or the London session, if you will. Then we have a bearish order block, and on the lower time frame, we'll see fair value gap. So we have bearish order block and a 5-minute fair value gap, which again we'll look at when we drop down to 5-minute. Price comes back up, hits that after running above equal highs. Power 3, distribution, comes right back up. Again, 5-minute fair value gap, you'll see that. Equal highs as well, distribution. Multiple fair value gaps in here. Okay, so I'm going to drop into a 5-minute chart so we can look at the 27th. Okay, so here's the 27th. Here's that fair value gap on a 5-minute chart I mentioned. And here's that high that we'd like to see it breach or touch. It's doing it here. And the time of day that it occurs, that's New York Open. So there's your entry. Then we create another fair value gap right in here. Price comes up. It completely fills. It goes a little bit into the bearish order block. All you need is this candle's high as your entry. Right in here at 131.29. The high on this candle comes in at 31, almost 32. So only 3 pips drawdown if you're using that entry point, and your stop will be above here. So there's nothing wrong with 3 pips drawdown. And the price comes down, creates another fair value gap, comes up, hits it. There's your entry again. the time of day for this one is London close. So you can use London close as a continuation. Aiming for what is residing below us, 131 big figure. Price distribution hits that. Fair value gap again. There's another entry point at which you can enter and use a stop above here. Price rolls over in the overnight session into Asia. We have a little bit of retracement. Creates a high here, small little fair value gap. Price comes back up. We move into Friday. The London session, fair value gap is closed. Sell off, small itty bitty tiny little imbalance right there. It goes into that just a little bit deeper. Sells off, and then we have our spike down into our first run below 130.70. Price rallies up one more time, taking out equal highs. Heavy distribution comes in again, sweeping 10 pips below, and finding our confluence of standard deviations on previous days inside of the weekly range and below our terminus, which was 130.70 calibrated off of that February low. Beautiful, beautiful, beautiful symmetry in the delivery of price. Perfectly calibrated, perfectly calculated. Nothing in this is ambiguous. Nothing is cherry-picked. There's nothing in here that you can't take away and use in other examples in the future, because these are the signatures that I've taught you right out of Model 5 content and all of the other core content blended together. So there's a high degree of precision here. We talked about this specific low being rated in previous commentaries. That was the target. That was the focus for the week, actually. And here it is delivered. So how many opportunities is there shown in this example? Just from the 27th alone, there's so many entry points you could have got in at. Previous day in here, you have a fair value gap. I didn't mention that when I told you I was going to show it to you on a 5-minute chart. Here's a fair value gap right there, and it goes a little bit beyond that into the bearish order block. But that's enough to fill. Your stop would be above here. And price has a heavy measure of distribution on the 27th. You can't look at this and not be impressed with how simplistic price moves, but it is highly technical to decipher. It's there every time, but it's basically evading the unlearned. So the uninitiated folks that are outside our mentorship, they have no idea. They have no capacity to understand what you're seeing here. And this is low end. This is low end of what's being taught in years to come in this mentorship. There's so many things that are much more precise than this that you'll learn, but you have to take these examples and use them as foundational understanding. And then you build on that as I introduce more things. It will become clear to you. My goal is not to take you into a trader of my caliber in 1 year or 2 years or 3 years. This is a club. It's a membership. So it allows me the freedom to talk to you folks about the things I don't generally talk about with anyone. So it's going to take time for you to learn all the higher order, but you don't need it. Obviously, I've shown you enough defined setups. So don't gripe. Okay, if your personality is those, oh, you're holding back. I've not held back anything. I'm continuously teaching. I'm continuously releasing new stuff. But it has to be done so in a graduated manner, because I've killed people in the past with free tutorials where it's been overload. And these people are still sorting through free level tutorials because it's a lot of content. So just know that you're here and it's all kinds of learning ahead. But don't think that you're limited by not knowing the advanced stuff yet. There's so many of you in here that send me emails, and whether you want to think it's respectful or not disrespectful, or it's just an innocent request or a comment or an opinion, it's very offensive to me when I hear folks that tell me, can you start teaching the really advanced stuff now? I know by experience, it just makes my job harder teaching it when you haven't been familiarized with the core content and then gradually moving into, look, you could have stopped, honestly, you could have stopped at month 1 content and found profitability with that. Because if that's all you're looking for, you have no excuse to be telling me, hey, give me advanced stuff now because I can't find profitability. Because if you can't find profitability in month 1, you're not a trader. And that's just it. I mean, period. End of story. You might as well just pack it up. Because I gave you everything that you would need to find profits just in month 1. And I did that month 1 with that in mind. So that way I could remove all the excuses for the average Joes and the average Janes that come in here that have character flaws within themselves that are going to be deterrents to them finding success in this. I packed a beautiful, here's what you do exactly, defined setups that repeat over and over and over again with the first month. So don't think that you need to know everything you're going to learn by being in this membership. It's the high end, the high order stuff. You don't need that stuff. I'm going to teach it, but you don't need it now to find profitability. If you think that, you're doing no different than what the retail class does when they jump from one system to the next. All the things I'm going to be teaching you are just refinements that bring greater precision and less trading. You're asking, give me more higher order stuff so I can find more trades. When it's the opposite. You find less trades that are higher quality and more refined in their framework. That's all that it is. So you have, once you've gone through and you reach charter level, you have everything in your repertoire to be a profitable, consistently long-term career trader. You have it all. You have money management. You have how to find setups, where to know where the market's going, how to add positions, how to mitigate losses, how to forecast high probability setups months in advance, years in advance with the seasonal tendencies. We've taught so many things for you to be able to do, and not just in Forex. All those things are applicable in stocks, bonds, and some people say that stuff works in crypto. So while I don't want to introduce crypto in the mentorship, it's just proving that you've learned a higher order of analysis that some of you just probably don't really fully appreciate, and you probably won't appreciate it until years from now. Or if you leave it and try to do something else, you're going to be like, this is not what I was learning with ICT, and I mean, go back to that. But if you're smart, you won't look to do anything else because, number one, it's not a sales pitch. You've already paid me because you're a charter. So you're here. Relax. Just take the content as you get it. Let it build you up. Let it edify you. And then grow from that. Don't push. Don't force. Don't require more. Be content with what you have because you have a ton. You have so much more than the universe at large in the trading communities that you're on a different level. So don't be discouraged. Don't feel like you need more because you don't, even though you're going to have more. It's not my goal to inundate you with more information because more information too fast will cause confusion. It'll cause self-doubt. And that's counterproductive. So I provide you a monthly lesson on a model that's already been revealed, and I give you amplifications of how I use these things in my analysis. When I talk about these markets going to specific levels, I'm not pulling things out of the air. I'm actually using the models I've taught you. And this is an example why I was telling you what I was telling you relative to the dollar CAD this past week and the week before. We were looking for this low to be rated. We were looking for it to go lower. We knew it was going to go lower. If it's going to go below an old low, you know the protocols for that. 10, 20, 30 pips. Notice we did not get down to the 130 mid figure. So there would be no necessity to sweep an additional 40 pips if we go mid figure, like we did with the full figure 131. So it's enough to go just 10 pips below our calibrated level at 130.70. Okay? So these are all the things that require thought and then balancing out what it is you think is going to happen. Some of you may have looked at this as, okay, I think it's going to trade down to the 130.50 level. Why? Why would you need it to go that far? That's greed. Okay? If you use the low-hanging fruit thresholds for your entries and your targets, it controls fear and greed because you're going to fear whether or not you're going to get that entry and exit, and you're going to be greedy trying to pursue the best of the best, the highest order of profit and the lowest measure of drawdown and risk. You can't have everything. You can't. It just don't have that expectation in your trading. Use the low-hanging fruit entry technique, okay, and be building an allowance, rather, for your trades to have a little bit of drawdown against you. It's nothing wrong with that. And over time, you're going to be refining it to where it's almost very next to none. But in the beginning, don't be fearful of having a little bit of drawdown. It's okay. In fact, you're going to learn a lot. In fact, in August, we're going to be doing drills that require you to sit through entries that are going to offer drawdown on purpose. Because I want you to feel what it feels like to be in those positions and then wait for the turnaround. Okay, so it's going to be really, really early entries. And that's part of the things you need to know. What it feels like to be in trades and trust that what you've done is still going to pan out. Now, that sounds rather arrogant. And if you read on social media, there's folks, it's happened this week. There's a guy that said, there's no way you know. Well, you're in honesty, there really is no way that I do know. I don't know with absolute assurity. I have a high degree of probability on my side and in my favor that the market's going to do what I think it's going to do most times. Now, it's not 100%, but the folks in the free forum areas in the social media, they interpret what I say as I know every single day, every single price swing, and therefore I should be a billionaire. And that's a highly inaccurate perception. It's myopic, actually. So you here understand what I mean by that. I know that there's a great deal of probability the market's going to go to that 130.70 level. And once it gets there, it has a great deal of probability that it's going to sweep 10 pips below that, 10, 20, and 30. You know that my threshold is going to be the low end, 10. In fact, I don't require the 10. If it trades to 130.70, that's enough for me. I'm getting out there. Okay? That's what I mean when I say, when you know that you know, that you know, then you know. And I know what I'm going to do in these setups. You're still learning how to do that for yourself. So don't let it be a discouragement. You should be inspired. Every time you look at these examples and I give you the analysis and I show you the fruits of what you have been taught, these are the things that I'm not going through in detail when I do the commentary, because those commentaries are for your learning. You're supposed to be practicing and doing the things I taught you in the lessons. Remember, the commentary is me pointing and then you are shooting. I'm playing rangefinder. I'm your scout. You're the sniper. I'm telling you, this is the way you got to worry about the wind. You got to navigate this, you got to navigate that, but your objective is, your mark is here. You got to arrive at that. And some of you are, well, some folks actually left because they want me to do all this for them. And I'm sorry I'm not running a signal service for you. I'm not going to do that. I'm doing way more than I should, in my opinion. So if I tell you where it's going to go, and I tell you what markets I'm not worried about and what I'm focusing on, I've done it. I've told you that. Euro and cable, we didn't have a whole lot of interest in that. I said that if we were going to put gun to our head and pick a market to trade, I would be in dollar CAD. Dollar CAD came out and did it again. So it's every week, every day, and it won't stop. Until next time, wish good luck, good trading.